Let's go. Let's go. Oh, testing, 1, 2, 1, 2. Okay. What the hell you want from me? Options. Today we're going to be doing options, talking about it, and we're going to keep it dumb, simple, stupid simple, easy, easy, easy. Just call and put options. And we're going to use Tesla as an example. So 2025 Tesla, plus how to cash out early if... I hate that surf. Here we go. And we'll also talk about how to cash out early to surf Tesla's crazy price swings. This stock's like a freaking yo-yo, up and down. It's quite chaotic, which is also a good thing. Especially you can trade the volatility. You can, you know, ride the wave, so to speak. So do you want to bet on it without buying the shares? Options are your move. Grab a drink, plug into the grid, and let's stack some credits. Segment 1. What are options? What are they, bro? What are they? Alright, newbies, listen up. Options are bets on Tesla's stock price. You buy a contract that lets you choose to buy or sell Tesla at a set price. That's called the strike. Oh. Yellow. Standing by? Oh shit, okay. I'll go and get changed. Sending out the love to you. Okay, I'm back. Gotta, you know, where'd we get up to? Oh, there we go. Yeah, so today we're talking call options. Yes. So the question is, do you want to bet big without buying the shares? Options are your move. Grab a drink, plug into the grid, and let's stack some credits. Did I say that already? Anyway, we'll say it again now. Alright, newbies, listen up. Options are bets on Tesla's stock price. You buy a contract that lets you choose to buy or sell at a set price called the strike. Called the strike before it expires. You don't own the stock, you're just guessing if it's going up or down. See? Simple stuff. So there's two types we're focusing on today. One is a call option. So that bets that Tesla's going up. Like Elon's dropping the new robotaxi. Hopefully, moon shoot, everyone, you know, rocket emojis and all that sort of stuff, you know? I don't know if I'm on the camera or not, because there's no screen. I've got no screen, so if you want to blast me in the comments or something, say, hey, well, I can't, oh, sorry, no bad words. So yeah, and then there's a put option. So a put option's bidding that's going down. Like Tesla's factory has a glitch, and there's something wrong, you know? Something like that. Yeah, you get the idea. So calls going up, puts going down. It's real cut and dry, that simple, and that's all we're going to go. We're not going on about covered calls, and we're just keeping it real simple today. So options are cheap. You can make big cash with little money, and you only lose what you paid. That's one of the biggest takeaways. But they are risky. Guess wrong or run out of time and your money's gone. Tesla in 2025, it's jumping like a hacker dodging lasers. The options are fire. Let's hit 2 bets and how to cash out smart. Does that make sense to you? Let's hit 2 bets. And when did I write that? So first things first, buying a call option. This is for your dreamers bidding Tesla's going to moon, which is one here. You've got one here. You buy a call, guessing the stock will climb before the option expires. It's cheap, but risky. Tesla's got to move fast. I mean, I wouldn't necessarily say it's cheap, but it's the cheapest way to control and leverage. So here it is. Tesla stock is around 350 in May 2025. You buy a call option with a 360 strike expiring in 30 days for $10 per share. One contract covers 100 shares, so you pay $1,000. If Tesla hits 400 by the expiration, your option's worth $40 per share, so that's $4,000. That's a $3,000 profit. But if Tesla stays below the 360, you lose your $1,000. So it's, you know. But this is all just an example, by the way. This ain't financial advice. And for the guys who are actually doing options or want to do options, the smaller the time frame, the more risk. Because realistically, who knows what a stock's going to do within a week or 30 days? Not many people know. It's you can have a high probability with a robotaxi rollout with Tesla, but what happens if they roll out and there's a problem? You know, so it's always risk. And the longer the time frame, like long term, you think a company's doing well and improving. Long term, your risk, in my opinion, personally, the risk is lower. So here we go. Now the smart play, sell to grab volatility cash. So yeah, that's what most like professional guys do. They don't buy an option and wait for it to expire and then close it. They'll buy an option, and if it runs in their favor, they'll sell it, months before the expiry if there's profit there, depending on your risk tolerance. It's a bit like when you bet on a sport, like, how you can bet on a sport, like football or whatever, and you can, if the bet's going your way, you can cash out. There's a similar vibe to that before the final result of their match. So Tesla's Wild Swings pump option prices. Say Tesla jumps to 370 in a week. Your call might now be worth $20 per share, $2,000. Sell it then, and you pocket $1,000 profit without waiting. Why? Tesla's volatility spikes the options price. So you cash out before the dip or time runs out. Wait too long, and a bad news tweet could tank your gains. It's that simple. It's like simple, but it isn't always easy. But they're not complicated. So, section 3. So the next is buying a put option. This is for you doomers betting that Tesla's going to crash. You buy a put, guessing the stock will drop. Same deal. Relatively cheap, risky, and it's time's ticking, For example, say Tesla's at 350 now, you buy a put option with a $340 strike, expiring in 30 days. Again, that's very short term, but for $9 per share. So that's $900 for one contract. So a contract controls 100 shares, remember? You remember that? If Tesla falls to 300 by the expiration or before, your put's worth $40 per share. So that's $4,000. Your profit's $3,100 after the $900 cost. But if Tesla stays above 340, you lose your $900. So the exit hack: sell early to ride the dip. If Tesla drops to 330 within a week, your put might hit $18 per share, $1,800. Sell it, and you bank the $900 profit. Volatility makes puts pricier when Tesla tanks. So you cash out before it bounces or expires. Hold too long, and a Tesla rally could wipe you out. Like I was saying before, you can cash out. If it's swinging in your favor, you sell to close your option contract. So let's go next. So there's a few. Oh man, my arm. My setup, obviously you can tell my setup ain't the best. But so the exit hack: sell early to ride the dip. Okay, section 4. Why Tesla for options? In 2025, it's a beast. Tesla's high volatility. It has big swings. It can sweat and launch up to 400, dip down, back down to 220, 480, 220. That's quite a broad swing. But options can screw you over. Don't get me wrong. So like I said before, time's short. Options expire fast. Sell early or lose everything. The wrong bet, guess up and Tesla dips, your cash is gone. And the volatility trap. Tesla's wild, but if it goes quiet or options fizzle out, you lose your premium. Okay, what are we up to now? Section 5. So that's pretty much it on the call and put options. Simple to play Tesla 2025 madness. Calls for when Tesla's soaring, puts for when Tesla's crashing. Sell early to cash in on Tesla's wild swings and dodge the expiration traps. And also there's a time decay. So the longer your options, the long ones, you get a time decay. You got to watch out for time decay. So what do you guys think? Drop a comment. Tesla going up or down in 2025? Got a crazy Elon theory? Hit that like button or not. Don't subscribe. Don't hit that like. No. Just maybe. Okay, so now we're going to talk about actually going in and how do you do it and what you've got to do. This will vary depending on your account and who you're with. But in most brokerage platforms like Robinhood, Webull, Ameritrade, Fidelity, here's how you sell an option or select an option, blah, blah, blah. You know what I mean? So you log into your account, open the app or the website, go to your profile, find the section that shows your open positions. So if you've already bought one, you find your open positions, select the option, locate the specific call or put option you brought, e.g. Tesla June 25 call for $360. And then you close to sell or close. Click on the option and you'll see an option to sell, close position, or trade. The exact button labels vary depending on your platform. So yeah. I think Robinhood, tap the option, then hit trade to sell. Webull, click on the option, then close or sell. There's small variations, but obviously, yeah, you need to close the option you already own, not start a new one. That is a big mistake. You don't want to do that. And also, yes, here's the other part here is you can set the price. So you can choose a market order, which sells at the current price that the stock's ticking at right now, or you can limit order, set your desired price. For beginners, market order is the simplest thing to do. Select market order and just close it or sell it, whatever you're doing. Confirm the sale, review the order, e.g. selling one contract for $2,000 and hit confirm, submit or place order, whatever your app is using. And then that's done. So the cash from the sale hits your account instantly or after settlement, usually 1 to 2 days. So key tip, check the bid price. What buyers are offering before selling to know what you'll get. For example, if your Tesla call is worth $20 per share, the bid might be $19.50. So you'd get $1,950 for the contract. It's pretty straightforward, guys, pretty straightforward. But, you've got to start somewhere. If you don't know, you don't know. And that's it. Cool. See ya. Love you. I love you. I love you, mate. See you guys. See ya. Thanks for watching.